Welcome to the deep dive. We're here to take that mountain of information you face and really distill it down into something clear, something actionable. Today, we're jumping into a really fascinating area: Wall Street myths and, well, folklore, you could call it. You've definitely heard them, right? Sayings like buy low, sell high, or maybe the trend is your friend. We all hear these things, but how much actual truth is behind these popular beliefs when you're trying to navigate the market? Our main source for this deep dive is Buy the Rumor, Sell the Fact from 2004. It really unpacks the sayings and, frankly, the misunderstandings that shape how people invest. So, our mission for you today: let's figure out which of these common ideas actually hold water and which are just, colorful stories that could maybe lead you down the wrong path. We'll touch on everything from seasonal quirks in the market to some correlations that are just, well, bizarre, and really understand why sorting fact from fiction is so crucial for your own investment journey.
Yeah, it's quite something. You see really smart people, capable people getting taken in by, let's say, dubious information when something's complex, like golf or dieting or investing. It's inherently difficult. I mean, history even gives us examples like J.P. Morgan apparently consulting spirits for stock tips. Seriously.
Yeah.
So our goal here is to get past the superstition, apply some critical thinking, and see what the actual data tells us about how markets behave.
Okay, that sets us up perfectly. Let's start with some of those really core beliefs you hear on the street. First one: no one can beat the market. It's a classic line, right? Especially from folks who love index funds. But is it really truly impossible?
That's a fundamental question. The book makes it clear, while most investors, individuals or pros, find it incredibly hard to consistently beat the market averages over the long haul. It's not, strictly speaking, impossible, no. Peter Lynch is the prime example the book uses. Managed Fidelity's Magellan Fund, 1977 to 1990, his returns, annualized 29%. The S&P 500 over that same time, 15%. So that clearly shows superior performance can happen. It can be achieved or at least mimicked, but it's very, very rare.
Right, so Lynch is the exception that proves the rule almost. What's the main takeaway for us, the individual investors, then? We shouldn't try to be Lynch.
I think the real insight isn't about chasing that kind of miracle performance. It's more about recognizing just how rare it is. And that really underscores the value of diversified, low-cost index investing for the vast majority of people with long-term goals. It's about playing the probabilities effectively.
Got it. Puts things in perspective. Okay, moving from beating the market to actually building wealth, you hear these two ideas that seem to clash a bit. First, money is made from single positions and kept with diversity. Okay. And then you also hear, don't average down on a loser, but at the same time, cut your losses and let your profits run. How do these fit together? Seems confusing.
Yeah, let's unpack that. If you look at entrepreneurs, say Bill Gates, real massive wealth often comes from holding a huge concentrated stake in their own company. That's the single position idea. But for most of us, the book hammers home the need for diversification. There's a study by Mark Repe, looked at data from 1926 to 1997. Fascinating stuff. He found that a staggering 97.5% of randomly picked large-cap stocks ended up with losses worse than 50%. That really shows the danger of swinging for those single home runs. Diversification works simply because stocks don't all move together. Some go up, some go down. So a diversified portfolio won't give you that one moonshot gain, sure, but it drastically cuts the risk of a catastrophic loss wiping you out. Think about Martha Stewart. Her wealth took a massive hit when her company's stock dropped 60%. That's the risk of too much exposure to one thing.
Okay, that makes a lot of sense on diversification. But what about cutting your losses? You hear that all the time. Sounds smart, but isn't there a risk of just selling low out of panic? Especially when the book also says to calm down if you're just spooked. How do you tell the difference?
That's exactly the tricky part. The book emphasizes that cutting losses should be linked to objective reasons. Has the company's fundamental situation actually changed for the worse? Or maybe your own financial situation has changed and you simply can't afford that level of investment anymore. That's rational selling. But if you're selling only because the price dropped and you feel scared, that pit in your stomach, that's when the advice is to pause, reevaluate. Because panic selling, it almost never ends well. It's about knowing if the company changed or just your mood.
That's a great way to put it. Okay, from those big ideas, let's shift to market mechanics. Some things get talked about that sound almost mystical, like triple witching day. Does that actually stir up crazy volatility, or is it more hype than reality?
Yeah, the name is dramatic, isn't it? It refers to when stock options, stock index options, and stock index futures all expire on the same day. Sounds like a recipe for chaos. But the research, Jerry Wang at Schaefer's Investment Research looked at 27 years of S&P 100 data. and found that triple witching days have pretty much the same average volatility, about 1% as any other trading day. If there's any effect, it's really short-term, hour-to-hour stuff that maybe matters to day traders. For long-term investors like you, it's basically irrelevant. More like fun financial trivia.
Okay, so triple witching is demystified. What about these other sort of philosophical sounding terms for market mood? The wall of worry versus the slope of hope. What are they getting at?
They're absolutely about investor psychology, yeah. The wall of worry suggests a healthy bull market actually needs some skepticism. It means there's money sitting on the sidelines, hesitant investors who eventually buy in, pushing prices higher. Think about the market dips in 1998 and 1999. People got worried, pulled back, but then earnings improved and money flowed back in, climbing that wall. A little worry fuels the climb. The slope of hope, on the other hand, that's different. That's money chasing temporary rallies during a bear market, even when the underlying company fundamentals are still bad. Short-term traders can get crushed on that slope. But interestingly, for patient investors, maybe using dollar-cost averaging, these periods can be an opportunity to buy more shares at lower prices, positioning themselves for when the real recovery, based on actual improving fundamentals, finally happens. It's about not getting fooled by those brief head fakes.
That's a really useful distinction. Okay, sticking with market assessment, let's talk PE ratios, price to earnings. We often hear the PE ratio works for stocks, but not for the market. Can we actually use PE to judge if the whole market is too pricey? Or is it more nuanced?
You'd think so, wouldn't you? It seems logical.
Hmm.
But the book argues PE is really best for comparing things. Comparing one stock to others in its industry, maybe. Or a mutual fund's PE against the market average. That makes sense. But the overall market, what do you compare it to? Only its own history. And history can be a tricky guide. Like in the late 90s tech bubble, the S&P 500's PE went above 35. Historically, the average was closer to 15, so people said, crash incoming. And it did crash eventually. But guess what? The PE never went back down to 15. So using historical market-wide PE averages as a strict predictor for crashes or exact valuation levels, the book suggests it's not that reliable.
Okay, so if the overall market PE isn't a super reliable guide on its own, what else is there? Is there any rule of thumb? What about the rule of 20? Does that have any merit for predicting market performance using PE adjusted for inflation?
The rule of 20. Yeah, the idea is basically take the market's PE ratio, add the current annualized inflation rate. If that total number is under 20, the market is considered fairly valued, maybe even cheap, and likely to do well. If it's over 20, it's potentially overvalued. And historically, there's some evidence for it. A 60-year study Glenn Tanner did showed an investor switching to safer treasury bonds when the adjusted PE went over 20, and then back into stocks when it fell below 20. Well, they significantly outperformed someone who just bought and held stocks, like $244,000 versus $134,000 in his simulation. However, and there's always a however in markets, right? The book notes that by 2003, the market was recovering, but the S&P was trading at 30 times earnings, even with low inflation, way above the rule of 20. So it raises the question, does the rule need updating? And maybe it's the rule of 23 now, or 25, depending on the economic climate. Inflation's impact on company profits is complicated. It's not always a straight line. So a simple rule might miss some of that complexity.
Right. No magic numbers then. Frustrating. Okay, how about this one? A rising tide raises all ships. Surely when the market's booming, everything goes up.
It feels like it should, doesn't it?
Yeah.
Especially because big indexes like the S&P 500 are cap-weighted. That means the biggest companies have the biggest impact. So if Apple and Microsoft are flying high, the whole index looks great. But if you're an individual stock picker, it's not quite that simple. Again, look at the late 90s tech boom. The overall market was soaring, driven by tech. But value stocks, like old-school industrial companies, Bethlehem Steel was an example, they were actually declining during that boom. So even in a strong bull market, there are winners and losers. Performance varies hugely between individual stocks, relying only on rising tide if you're picking stocks. The book calls that a dangerous religious commitment. You still need to analyze the specific company.
Okay, that's a good caution. Which leads us nicely to another big strategy question. Buy the whole market.
Yeah.
Just grab an index fund tracking everything. Is that really the safest, best approach for everyone? Or are there catches?
Buying the whole market, usually through a low-cost index fund, like Vanguard's Total Stock Market Index Fund. Yeah, it's a solid strategy for many. It's cheap, it's easy, and it basically plays the odds. History shows only about a third of professional, actively managed funds actually manage to beat the S&P 500 over time. So buying the index is a sensible default position. But the book brings up a counterpoint from Craig Israelson. He points out that these total market funds are usually market cap weighted, which means they end up being dominated by the really big large cap stocks. You get less exposure to small and mid-sized companies than you might think. So Israel suggests maybe buying separate index funds for large cap, mid-cap, and small cap stocks. That way, you control the balance and can potentially get broader diversification across company sizes, maybe even better returns. It's about whether you want that broad exposure or a more tailored weighting.
That's a really interesting nuance on buying the market. Okay, another common approach is trying to follow the smart money. Looking at analyst price targets, tracking what big fund managers are buying, or even what company insiders are doing. Is that a reliable path for us?
Right, the idea of riding the coattails of the experts. Let's break that down. First, analyst price targets. The book suggests maybe don't pay too much attention. Henry Bludgeon himself, remember him from Merrill Lynch. Admit these targets are often kind of arbitrary. They can distract from real fundamental analysis. Sometimes a buy rating almost mechanically forces the analyst to set an optimistic price target, whether it's truly justified by valuation or not. And following analyst consensus, that can mean you're actually late. Christopher Johnson from Schaefer's Investment Research points out, if like 24 out of 25 analysts covering the stock already rated a buy, well, who's left to buy it and push the price higher? There's no more sideline money from upgrades. These stocks are often seen as overbought and really vulnerable to big drops if there's even a hint of bad news. Johnson actually suggests looking for companies analysts don't like, or maybe ones they just ignore altogether. Contrarian thinking. Then there are company insiders. Tracking their buying and selling seems smart, right? They should know best. But their reasons for trading often have nothing to do with your investment goals.
A wealthy founder might sell millions in stock just to diversify their personal wealth, not because they think the company's about to tank. And remember Sam Waxel at ImClone, convicted of insider trading. He sold based on what he thought was bad news about a drug. He ended up in prison, and meanwhile the drug actually showed promise later. So even insiders can be wrong about their own company's future. Their perspective isn't always clear or even correct.
Wow, okay. So smart money isn't always smart, or at least their motives might not align with ours. It really comes down to understanding potential biases, right? And making sure any advice fits your timeline, your goals. That's crucial. Now, we've seen the market isn't always logical, and humans love patterns, which brings us to another whole category. Seasonal investing myths, things like the January effect, or as January goes, so goes the year. Sell in May and go away. Avoid the October surprise, the Santa Claus rally. Do any of these calendar-based ideas actually hold up under scrutiny?
Ah, the calendar myths. Yeah, these tend to rely more on coincidence, maybe a little bit of data mining, rather than any real economic logic. Sure, you can look back at historical data and find months that on average did slightly better or worse, like maybe July was often the best for the S&P 500, September the worst. But the differences are usually tiny. Try to jump in and out of the market to capture a few basis points based on the month. The book basically calls that ludicrous, and a sure way to lose money through trading costs and potential mistiming. And think about the contradictions. Like the January barometer, as January goes, so goes the year. But that clashes with the January effect, which says small cap stocks specifically rally in January. If both were reliably true, the market would just always go up. Doesn't make sense. The book points to 1987 as a great example. January saw a huge gain, over 13%. According to the barometer, the year should have been great. But if you'd waited until February 1st to invest based on that signal, you'd have ended the year down 10% after the October crash and the October surprise fear. It's mostly because of the big crashes in 1929 and 1987 happening in October.
Pure coincidence. The market, fundamentally, doesn't care if it's Halloween or Christmas. Trying to time things based on these patterns, it's often, as the book says, a nearly sure path toward buying high and selling low.
Right, so chasing calendar pattern is probably a waste of time and money. Okay, now for the really out there stuff, the kind where you just have to ask, people actually believe this. I'm talking the Super Bowl theory. The markets fall when the Mets win the World Series. The market falls when a horse wins the Triple Crown. Even things like the cocktail shrimp theory and short skirts. Are these just funny stories, or is there any conceivable insight? The Super Bowl one gets me every year. Have you ever encountered one so weird it almost made you think, even for a split second?
Well, absolutely. It's human nature to see patterns, isn't it? Even absurd ones. But yeah, these are what the book calls loony notions and snake oil pitches. Pure coincidence, dressed up as prediction. Take the Super Bowl theory. The original version was, if a team from the original NFL, mostly NFC now, wins, the market has an up year. If an original AFL team, mostly AFC, wins, it's a down year. It's supposed success for many years, mostly because the market tends to finish up most years anyway, and the NFC happened to be dominant for a long stretch. Correlation, not causation. And when the Denver Broncos, an AFC team, won back-to-back Super Bowls and the market didn't crash, they literally invented the Elway exception. It's just making it fit after the fact. Pure absurdity. The Mets World Series curse, based on his 2 wins since 1969. That's not a pattern, it's random chance. The Triple Crown horse myth, easily busted by looking at all the years the market fell when no horse won the Triple Crown. And shrimp size, or skirt hemlines. Come on, completely disconnected. The cocktail shrimp theory, bigger shrimp at parties, means market confidence is debunked by the simple fact that shrimp have generally gotten smaller since the 70s due to overfishing. Nothing to do with the Dow Jones. And the short skirts theory ignores entire decades, like the booming 90s when fashion was much more casual, lots of women wore pants, and the market soared anyway. They're fun anecdotes, maybe, but financially totally useless.
It really is a good reminder, isn't it? People will look anywhere for a reason, a pattern, especially when markets feel random. But usually, it's just noise, just coincidence. Okay, let's pivot back to some more grounded but still common misunderstandings, things about safety and investment structures. First one, mutual funds are safer than individual stocks. Is that always true for you, the investor?
Generally speaking, a well-run, diversified mutual fund is safer than putting all your money into just one single stock. That part's true. Diversification helps. But, and this is a big but, there are thousands of mutual funds out there. Over 5,000 mentioned in the source. So picking the right mutual fund, that can be almost as challenging as picking the right individual stock. And the real issue the book flags is fees. Fees can kill your returns. Many funds have front-end loads. That's a sales charge you pay up front, sometimes 5.75% or even more. Your money is down before it even starts working. Plus, there are ongoing annual management fees, expense ratios. The average for U.S. stock funds was around 1.4% back then. That eats into your gains year after year. So the advice is clear. Always look for no-load funds, no upfront sales charge, and funds with very low expense ratios. Fees matter a lot.
That's a huge point about fees. Easy to overlook. Okay, another belief, maybe more common among wealthier investors. Sophisticated investors are in hedge funds. What does sophisticated even mean here, officially? And are hedge funds automatically a better choice if you qualify?
Right, sophisticated investor sounds impressive. The SEC has a definition. Basically, back then, it was someone with over $200,000 in annual income or $1 million in investable assets, including their house, which honestly isn't as stratospherically high as it might sound. A lot of people could reach that level by retirement, especially with home equity included. Now, hedge funds. They definitely have an aura of exclusivity, glamour. They often choose their investors, not the other way around. But the term hedge fund itself has become incredibly broad. It doesn't mean just one thing anymore. Originally, the idea was to hedge holding both long and short positions to try to get steady returns whether the market went up or down. But the data shows even millionaires aren't immune to losses. Between 2001 and 2002, 100,000 millionaires in the US and Canada actually saw their net worth decrease. It shows that, as the book says, staying rich can be as difficult as getting rich. Unquote. And for most people looking at less regulated investments, like smaller limited partnerships often marketed as hedge fund-like, you often have to give up control, voting rights. Due diligence becomes absolutely critical.
Big institutions vet these kinds of opportunities carefully. If your advisor or a major bank hasn't heard of some exclusive deal you're offered, probably best to steer clear. Sophisticated doesn't guarantee safety or better returns.
That's a really sobering point. Sophisticated might just mean you qualify to lose money in more complex ways. Okay, what about a very fundamental principle? Riskier investments promise higher returns. Seems logical, right?
Seems logical, and it's partly true, but it needs a really important tweak. Riskier investments promise higher returns. They absolutely do not guarantee them. That's the critical difference. Look at the periods in 2000 to 2002 again. The total stock market declined 14%. Pretty risky, right? Long-term treasury bonds generally considered very safe. They were up 14% over that same period. So that clearly shows, as the book puts it, risk and higher returns don't always walk hand in hand. Sometimes risk just gives you, well, losses. The real lesson is, anytime you hear a promise of high returns, your first question should be about the risks involved. Understand the potential downsides, the contract details, before you jump in. It's about risk awareness, not just chasing promised returns.
Promise versus guarantee. Got it. That's key. Okay, finally, let's talk about buy and hold. The classic advice. Sounds simple, build a diversified portfolio, leave it alone for decades. But is it actually effective, especially when markets feel so jumpy and everyone seems to be trading?
Yeah, buy and hold. It's probably one of the most talked about strategies, and maybe one of the least believed or followed in practice. The data showed the average time people held onto a stock actually dropped significantly in the 90s, from about 28 months down to just 16 months. Lots of trading. But the numbers supporting buy and hold are pretty compelling. The book used an example. An investor puts $1,000 in the market in 1980, does nothing, just holds on. By 2000, they have over $16,000. Now, compare that to someone who trades actively, maybe like a typical mutual fund manager back then, turning over 85% of their portfolio each year, that active trader. They only ended up with about $80,100. Why? Taxes and trading costs ate away a huge chunk of their returns. There's constant pressure from brokers, from the media, to do something, to trade. But often that activity benefits the brokerage house more than it benefits you, the investor. Now there's a related idea, catching falling knives, buying stocks that have dropped sharply. Can that work? A study by Charles Brandis suggests it can work, but importantly, within portfolio context. Meaning you buy a basket of these beaten down stocks, highly diversified.
It requires a really high tolerance for risk, and again, significant diversification is key. It's not about picking just one falling knife. For most individuals, sticking to fundamental analysis, looking for companies with strong assets, low debt, good future prospects, that's still indispensable. And setting realistic expectations is crucial. Vanguard founder John Bogle suggested aiming for maybe an 8% average annual return from the market long term, with only about 1% of that coming from dividends these days. Try to chase 20% returns year after year. That usually just leads to taking on too much risk, making bad decisions, and ultimately disappointment.
That really brings it all together. Realistic expectations, focus on fundamentals, beware the costs.
Okay, we've covered a lot of ground here, navigating through these market beliefs, some sensible, some really silly. What's the big picture that stands out most to you after this deep dive?
Going through all these myths, from the plausible-sounding ones to the downright bizarre, it just reinforces a core truth for me. The market isn't some predictable machine that follows calendar dates or Super Bowl scores. It's not driven by superstition. It's a complex system, driven by fundamentals, yes, earnings, economic conditions, but also heavily influenced by human behavior, by investor sentiment, by reactions to news, often in ways that are hard to predict short term. The appeal of finding a simple pattern, an easy answer, it's incredibly strong. But the data, again and again, points towards needing a more disciplined, less reactive approach. Yeah, and maybe the most important takeaway for you listening to this is to bring a healthy dose of skepticism to all the market information you encounter. Don't fall in love with a particular stock or a particular theory, and always remember that just because a company is good or you like its products, that doesn't automatically make its stock a good investment at any given price. Diligence, doing your homework on the fundamentals, focusing on the long term, staying diversified. That seems to cut through the noise much better than relying on the latest hot tip or, the Super Bowl outcome.
And that really brings up a final important question for you to think about. In this world overflowing with information, with advice coming from all directions, often with hidden agendas, how do you actually figure out whose interests are genuinely aligned with yours when you're seeking help with your investments? Who can you really trust?
That's a powerful question to leave things on. And that's a wrap for this deep dive. We really hope you feel a bit more informed, maybe a bit more prepared to view market wisdom with a critical eye. Until next time.